Hi traders, this is Frank speaking to you in the early morning hours of Thursday, February 14th, 2008. As promised last week, I wouldn't take as long this time to crank out one of the charts of the week presentations, and again, thanks for your patience last week. I'm going to go over actually a trio of really quick back-to-back trades. Kind of an interesting scalping approach we're going to take a look at this week. And the trades were on pound USD, pound yen, and pound Swiss, which I've abbreviated accordingly here. And hopefully you're going to find this kind of an exciting spin on all of the proceedings to date, throwing something new at you this week. So I hope you really enjoy it. Just a quick little preface to the proceedings. By the time you get this, St. Valentine's Day may have come and gone, but regardless, happy Valentine's to you. I just came across this picture surfing the web, and I thought it was pretty cool. And if you have not spotted the Valentine's greeting embedded in this picture, please look more closely. Anyway, I hope it's a great day for you, whether you choose to observe it or not. Okay, folks, here we go. And now, introducing the one, the only Four Sisters trade. I know this is all extremely cryptic. I just kind of like this guy over here. He's my funky MC. I think I'll call him Reggie. He looks like a Reggie. Cool guy. And I kind of like this picture too. The Four Sisters. We've not discussed the Four Sisters trade before. You've never probably even heard this term before. I just made it up tonight to describe this trade I've been using for a little while now. And we're going to commit some major heresy here. In a course that's designed to explain how to use and interpret MACD, we're going to actually take a bit of a break from MACD. Yes, it's true. We're going to temporarily say adios MACD, and we're not going to even work with you at all. Now, the reason why is not it's not because we're having a change of heart here or suddenly don't like MACD anymore, or nothing of the sort. It's just what I'm trying to do is kind of open up some different possibilities for you to look at. Not everybody likes MACD as much as I do. Some of you like different indicators better. We're gonna work with a stochastics-oriented indicator in this trade and use that exclusively. I mentioned kind of in passing last week. And my buddy Jeff Brooks there, he was asking, what did you mean by simplify? Well, what we're going to do here is look at a very dead simple trading system, so that if you are finding yourself getting really hung up with top-down analysis, if it's just driving you crazy, and let's face it, that does happen to all of us, regardless of our experience level from time to time. I'm going to give you a trading system here, just a quick little simple trading system that you can use to generate consistent pips, not large pips, but consistent pips, and it just might take some of the stress off of any situation where you're looking at a whole slew of charts and you just can't make heads or tails of what's going on. This is a very simple way to approach the market. So I hope you appreciate that. And again, that's the only reason why we're taking a bit of a break from MACD in this, is I just wanted to show you a very simple system you can use. And this might actually be really good, especially for newer traders, who are just in a situation where, if you want somebody to show you a system where you can just consistently start generating those 20 to 25 pips a day that Peter talks about in his course. He's mentioned that numerous times. When you're just starting out, don't go for the roses, just go for the simple trades, and this is a simple trade that can help you achieve that objective. So to state the obvious, what the heck is a Four Sisters trade? Let me see if I can describe it simply. It's an alternative to the MAP system that we've been working with. The MAP, of course, standing for MACD Parabolic, and as you recall, it's a bit cumbersome on your screen. I'm the first to admit it. It's hard to fit four indicators on your screen, and there is a case to be made that you don't or shouldn't need to, yet it works. So that's the only reason why I've returned to it over and over again. It just works. So I'm not going to get too hung up in the details, but this is an alternative to the MAP system. So what I'm going to show you in the later trade examples is how this is applied on the 3-minute chart. I don't know why, but the 3-minute chart I like it. It's just, you can use a 5-minute, you can use a 10-minute, you can do this on the 15-minute chart, whichever low-level time frame you like to work with. It's up to you. I cannot explain why I like the 3-minute chart. I just do. It's kind of faster than a 5-minute, but slower than a 1-minute. I don't know. It works. Limited risk. I think that's the thing. The parabolic stops are just so nice and tight. So what we're doing, again, getting back to this theme of simplification, we're stripping out some of that, some of that clutter on our charts. If you perceive it that way with the 4-indicator setting, we're going to get rid of the slow MACD, we're going to get rid of the fast MACD, and we're going to get rid of the RSI. And again, this is just a different idea I'm throwing at you. It's not to suggest you have to consider a complete change of approach as compared to some of the past trading examples. But what we're going to do, the Four Sisters, what they are is a quartet of exponential moving averages. On the 3-minute chart, and again, you can put these on any chart you want, they'll kind of have the same meaning. But the 4 EMAs we're using are the 800 EMA, the 400 EMA, 200, and 100. Now, depending on how you think of it, these are all of these actually are different variations of the same thing, a 200 period moving average. I mean, we have a 200 period moving average here. The 400 EMA is just the 200 EMA from the the next logical time frame up, and so on with the 800 EMA. A 100 EMA is just a 200 EMA from the next lower time frame. So these are all sort of replicating that magical formula for moving averages, the 200 period EMA, which again Peter keeps coming back to over and over again. Very popular indicator. And if you're kind of thinking to yourself, well, you've got 4 different moving averages, is that like a guppy system? No, actually it's not. First of all, it's a lot fewer lines on your chart, which makes it easier to read. Second of all, as I'm going to show you, we use it a little bit differently. I think of guppy as kind of really, at the end of the day, is really just a two-setting moving average. I mean, there's a group of fast moving averages and a group of slow moving averages, but really those are just 2 groups which are more or less equivalent to 2 individual lines. But what we've got here is a quartet of 4 different moving averages, and we're not reading 2 pairs of them against each other. We're reading 4 of them hand in hand. So I know that might sound a little bit esoteric as I try to explain it, but it'll become clearer when we look at an example on the chart. So next, in addition to the 4 sisters, we have just a single oscillator, and I'm going to use SMI. That's the sole indicator I've retained from the MAP entry signal system here. And we're going to use that to read peak readings, overbought or oversold. I think SMI probably does as good a job as any indicator for that. And we've also retained the parabolic SAR and pivots as well. The pivots in these examples are not going to be too terribly important, but you always have to work with your pivots if you're trading intraday. It's just, you're taking too big a risk to just ignore that information. So there, in a nutshell, is just a verbal description. Just one more footnote as we approach these chart examples. Again, if you're going to compare your charts you're working with to mine, and you're looking at the pivots and they look very different to you, just as a reminder, with the professional subscription version of IT Finance, which I'm using, the default is to midnight GMT as opposed to midnight Eastern Standard Time, and the pivots, of course, are painting in differently. I have to say, I think I mentioned it last week, but I'll mention it again this week, and I've had now a couple of months under my belt of experience with using these GMT pivots instead of New York pivots, and I've really come to the conclusion they're superior. There's absolutely no question that the market respects these pivots. As a matter of fact, I did a back-to-back analysis. I was looking at a 15-minute chart over a week-long period for a couple of different pairs, and what I just basically did was circled every instance where price respected a pivot on one system versus the other, and I actually had more meaningful support resistance events with the GMT pivots. So I'm forming the opinion that they really are superior, but it's not to say you can't still use the Eastern Standard Time. Of course, they're effective as well. It's just I think these are as good, possibly even better. So anyway, just a footnote, if you're wondering why they look different, that's the reason. Here are some simplified decision rules for trading the Four Sisters trade. First and foremost, what you want to do is you want to look for clear and consistent angle and separation up between all four of these individual EMAs. That's very important. You want to have them stacked clearly long or short. Sometimes they will not do that, and yet price will take off nicely and give you a good trade. That's fine, because what we're trying to do here is just take a dead simple approach and maximize our probabilities for success by trading with a strongly trending market. So you're going to want to see your EMAs stacking like this for a long trade, or like this for a short trade. And what's always going to happen in this type of scenario, you can see I've got these guys labeled from lowest to highest. In an uptrending market where these EMAs are stacked long properly, the 800 is always going to be on the bottom, 400 next above it, 200 next above it, and 100 period EMA is always going to be on top. Always, to fulfill this paradigm. And if you get some wishy-washy readings where the 100 crosses the 200 and the 200 starts to slope down and so on and so forth, well, then it's basically violating this paradigm, and the simple rule is you don't look for a trade. That's all there is to it. You can apply a really selective, picky approach and just say, okay, currency pair XYZ, you either give me this trending condition in the market, in which case I'll look for a trade, or you don't, and I won't, and I'll just scroll on to my next pair and just keep looking for this generic type of reading here. And similarly with a bearish stack here, the red arrows, same sort of thing. The 100 period EMA is always going to be at the bottom, the 200 next, 400 next, and the 800 always is going to be the next. And that's just because of, obviously, these a 100 period moving average is going to be more responsive to price action. So it's going to be the first to cross over in the downwards direction, and it's going to be the first to cross over in the upwards direction. So for a long, that's what you're looking for. For a short, that's what you're looking for. Now, once you've used the system to identify the tradable trend, we next look for a simplified version of the map entry signal, which is when we get either an overbought or oversold crossover situation on SMI. And we're going to use that to basically flag dips in the uptrend or rallies in the downtrend, which we buy and sell respectively, of course. Then we'll use parabolic this exact same way we had in previous examples with the map system. Once we've got the basic setup that we're looking at, we're sitting on the edge of our seat. We see that the trend is up. We see that SMI went oversold. We wait for the parabolic to flip, and that both gets us into the trade in terms of the timing and also gives us our stop. Now, here's the thing that makes it dead simple. For this system, we're always going for 25 pips. That's all we're doing, just 25 pips. You don't have to stress out about price projections or this, that, or the other thing. Next week, I'm probably going to show you actually a different variation of this trading system. You can either use this simple 25 pip limit, or you can use the system as more of a pivot trading system. So let's say that you get a buy as price comes down to the central pivot in an uptrend, and you target either R1 or R2 or what have you. But if you just like the comfort and convenience, let's just say that you're just happy to get 25 pips on a trade, and you know that there are going to be all sorts of fancy price projections that say it might go 150 or 175 or 80 or whatever. If you're just happy knowing that you've got 25 pips in the bank, so to speak, then this is going to work fairly well for you. So those are the simple decision rules, and I'm sure you would agree. I mean, that is about as simple as you can get. So just to put some real-life examples to that sort of textbook type diagram I just showed you, these are actually hourly charts. Well, this one and the next one anyway. So this isn't necessarily, the time frame you'd trade on, but you could see actually in this example, nonetheless, having stated that, you could trade it the same way. We've got the 800 on top, 400 beneath, 200 beneath, 100. This is about as clear as it gets. And if you're looking at this kind of trending market indicator on the 3-minute chart, I mean, it just, what do you do? Well, you think short. Now, of course, anybody who's going to play the devil's advocate is going to say, well, gee, Frank, at some point you're going to get a sharp pullback, which runs totally counter trend to this indicator. We know that the EMAs are lagging indicators, and it takes a long time to turn them over. That's true, very true. But the reason why you don't really, as a rule, have to think about that too much is because, as I noted in the previous slide, the system works best with high-ranging pairs, and that typically includes the British pound cross pairs, pound yen, pound Swiss, pound Aussie, pound dollar, pound loonie, pound Swedish kroner, pound Norwegian kroner. Any of these pairs that have a really high daily range, the reason why this works so well, irrespective of those other issues, is because quite simply, it's just not hard to get 25 pips out of those pairs. If you're getting a trend signal like this and an entry signal where you have SMI hitting a peak reading like those guys there, it's just, even if the market does end up turning around in the session in which you're trading, it's pretty hard not to get 25 pips out of those pairs. I don't know that I would necessarily recommend trying this out on pairs with a very low average daily range, or that tend to be less volatile, and some examples of those might be, for example, Euro USD, which can be often very sluggish as an intraday trade anyway. Euro pound, yes, of course, the pip value is much higher than most other pairs, but still, that's a pair where actually you would be hard-pressed to get 25 pips movement out of it sometimes. So stay away with this system from the slow-moving pairs, and try to apply it with the faster-moving pairs with the higher daily range. And like I say, any of the British pound cross pairs fits the bill beautifully. But in any event, that is what a bearish stack on the Four Sisters EMAs looks like. We'll take a look at the flip side of that. Here we have a long stacking on the EMAs, and you can see actually back here we had a golden cross of the 400 over the 800, and then back further in the background the lower setting moving averages similarly gave us bullish or golden crossovers. You'll want to pay close attention to those crossover events in this type of system. When they're coming, 1, 2, 3, 4 of them back to back in a fairly close proximity, and then these lines start to widen out like this, it's a pretty good visual clue what's going on here. So this one isn't quite as neat and tidy as the last one, but it is valid nonetheless. And again, this is a 60-minute chart, so within all of this many hours long time frame of price action, you will have had plenty of indicators on the 3-minute to both trade with and actually trade against. I would bet you dollars to donuts, where my cursor is here, where we had this pullback on the hourly chart, our 3-minute indicators would have gone bearish, and you would have had some good opportunities to trade this thing short, even though on the 60-minute time frame it was opening up as a bullish stacking of these EMAs. And here's some crossovers on SMI, which kind of line up nicely. So again, somebody could take a look at this and say, oh gee, okay Frank, well, here's another crossover right here, which I didn't circle, and you would have been going long right at the top of the market, and look what happened after that. Well, again, this is a 60-minute chart. Okay, I could easily, even within the space of, this looks like about 8 hours here, I could easily have pulled off at least one 25 pip trade if the 3-minute stacking was long in harmony with this hourly. So that's why some of the stringent requirements of top-down analysis and so forth can be loosened up a little bit. I'm going to talk more about that towards the end. But again, I'm working on just quick in and out intraday trades. So however things shake out on the hourly chart, generally speaking, doesn't matter to me, because most of the time I'm going to be right. And if I try taking a short right here, right at the bottom of the market, if I get stopped out once, I'm certainly going to start looking at other time frames to try and give me a clue as to why that happened, and I'm going to probably think about whether this thing is ready to turn around here. On this particular example, price went really overbought here. Price is way above these moving averages. We can read that generically as an overbought reading, and then it came down here and found support in the 200 EMA. So if I had tried to go short here and it didn't work, well, I'm getting a clue here on this hourly chart as to why. We've got support coming in at the 200 EMA, and on the SMI indicator we're deeply oversold. But anyway, that's not the point. The point is this is what a bullish stack on the Four Sisters looks like. So now that we've seen a couple of examples of what a good stack looks like, here's an example of what one doesn't look like. This is really bad, and this is the kind of signal that you want to sit out. You just don't want to take your chances when the market is in a bit of a funk like this. This is actually a 3-minute chart we've got for this particular example. So yeah, sure, the 800, which is the thickest of these lines, is sloping gently down. It's bearish, so it is a bearish signal. And now that I say it, actually, this is pound Aussie. Some of these bearish signals, actually, a couple of them would have worked. This one here would have worked. You would have gotten 25 pips out of here, I believe, if I'm reading that correctly. 1550 up to 1600. Yeah, that's 50 pips. This one wouldn't have. This one wouldn't have. This one would. This one would. So you can see it's kind of hit and miss here. That's why you want a strongly trending market instead of a compressed or range-bound market like this one is. It's just too hit and miss otherwise. So you don't want to trade when your lines are all jumbled up like this. If I had put a Bollinger on this, what it more likely than not would have shown is we would have had one of those constricted channels that the Bollinger Bands will sometimes do before there's a breakout move and you see those big bubbles that start to form. So yeah, if you had a reason to expect which way this thing would break out, you could act accordingly. But just trading this system simply, this is not a super clear, super obvious, crystal clear kind of trend indicator. So the simple decision then is, well, I'm not going to look for a trade on this pair, at least not until such time as these moving averages start breaking out one direction or the other. So let's turn our attention to a couple of trade examples now. And here is an open positions window. And as you can see, this is 3 trades. Again, all cable crosses: pound Swissy, pound dollar, pound yen. I only took half lot trades here. I could have easily done 1 or 2 lots. Doesn't matter to me. But I wanted to just scale it back here a little bit because I wanted to make this trade more how would you put it? More applicable. Sorry, for some of the newer traders who are maybe not comfortable with the idea of putting down 1 or 2 lots, but would rather look for smaller position sizing in the range of 50K or 40, 30, 20. 1 mini, what have you, just to put this into a realistic kind of perspective here. So you can see I've got all these trades. The interesting thing about them, of course, being that they all opened up at about the same time, 1:34 a.m., more or less. And you will see that often. These cable crosses will often, not always, but often kind of do the same thing at the same time. You don't enforce that expectation, but when you see it, it's kind of interesting. So here is just to make clear what the risk factors were. This is with the parabolic stop working hand in hand with SMI, and that is net of my dealing spread, which is not too bad. or sorry, I shouldn't say net of, I should say inclusive of my dealing spread. So 20 pips on pound Swissy, and I'm paying 10 pips on the spread, so that's about as tight as you can get. Pound yen, 33 pips, not bad for this pair. I'm sure anybody else out there who trades pound yen pretty regularly would tell you it's often hard to get a stop that tight. And then, that was, did I mess that up? That was 33 pips on pound USD, 26 pips on pound yen. So actually, a little unusual. Usually you would get a lower stop on pound USD. Anyway, here's a closed positions window. You can see that this is one of the neat features of this system, is that it's a real quick in and out trade. I was out of the market in 20 minutes on the pound yen trade, and about 25 minutes on the two other guys. So, the action was over inside a half an hour on these three guys, and there was a 25 pip limit on all three of them. I think I must have messed up my math here, because that should have worked out to 375, not 374. But anyway, you can see for half hour's worth of work and pretty modest position sizing, a half lot trade on each of these three guys, that's $352 US. And I wasn't even really watching what was going on. I was actually starting to put this presentation together. I wasn't even going to trade tonight, but I looked and I thought, okay, looks good, let's try it. Maybe I can use these examples in the presentation, and here we go. So again, on half lot trades, to pull down $350 in a half hour, that's not bad. Obviously, if this was a full lot trade, that would be $700. And if you're putting two lots down on each of these guys, that's $1,400 in a half an hour. That sure is better than any day job I've ever had before. So now let's take a look at the chart examples behind each of these trades. This is where you'll see how just dead simple this system is. This is the trade for pound yen, and we got 25 pips out of it, just like the other two. But to start off with, coming into the 14th, midnight Eastern Standard Time, which is more or less around the time I get to sort of log in and take a look at the charts. The first thing I saw was we had the 800 painting in green, nice positive slope. Same for the 400. The 200 and the 100. This is a bullish stack, crystal clear. It's about as clear as it gets. And the other thing I probably should have pointed out here was in the background we know we had some good bullish price action over the last roughly 24 to 48 hours. The pound is starting to move, and if I was going to be a real completist about this, should probably point to the fact that the big dogs are really pushing the pound up. They're long. Peter's going to talk to you next week about a new COT-based indicator system that I've come up with, which I'm just brimming with excitement for, and I can't wait to roll it out. How's that for a sales pitch? But anyway, this system has nothing to do with commitments of traders, but I just mentioned that as passing. It's quite interesting. We've had some good lift in the British pound this week across pretty much all the cross pairs, I believe. Anyway, this is how I read this. Coming in at midnight Eastern Standard Time, bullish stack. The first thing I see is this SMI is overbought. Would I go long here? No, of course I would not. I'm looking for a dip in the uptrend. And that came down here as SMI dropped off the map. Interestingly, we saw price find support not on the quarter pivot here, which I've drawn in just above the central pivot, but rather on the 200 period EMA, one of the four sisters. And so this had me, perched on the edge of my chair. When I see this, I know it's counter trend. It's a pullback. The trend is still up. It's still viable, so I want to wait for the dip. Then, SMI is kind of going oversold here. I'm going, great, excellent. Let's wait for parabolic. Parabolic obliged right here. As soon as this thing flipped green, I'm watching this in real time. Boom, in you go. And ask no questions, take no prisoners. And you put your stop right here at the parabolic. For the cable trade, I was a lot closer to the central pivot, so as I'll show you in a minute, I actually used the pivot as a stop reference. But here, it was just a classic, this is a map style entry. The only thing that's different between this and map, of course, is we don't have the MACDs and we don't have RSI, but in this case we don't really need it because we have an uptrend and we have a dip. What do? We buy. And so this red arrow, the green arrow shows where I got in, the red arrow shows where I got out on the generic 25 pip limit, and you can see price kept going. I don't have the full view here, but in this type of system, I really don't care. I'm applying a single-minded focus on taking 25 pips out of the market. I don't care how far this thing goes. That's what I want. That's what I'm shooting for. And once I've got it, I'm out. At least until the next time I get another dip, and if this trend is still valid. So is that simple or what? I mean, I'm not looking at the weekly chart here, or the daily, or the 4-hour. I peeked at the 1 hour. It's pretty important to do that. But this is simple. And the thing that's neat about these two higher period EMAs is that they do replicate kind of a higher level time frame on this chart. These do give you facsimiles for the trend on higher level time frames, which we're replicating down here on the 3-minute chart. So it's good that way. You can see if you didn't have these two thicker lines here, it might be a little bit confusing if you were just working with the 100 and the 200, which on a 3-minute chart, of course, obviously is not very much. You can see price poked below both of these skies. They started painting in red. You probably would have been wondering whether we were going to have a death cross here. But put in context of these two higher level EMAs, this kind of stuff here is just a fake out here and here. And so you get oversold, you buy it, you get out. There's $250 on a single lot trade. And this all, when you get these, it's surprising how often it is a quick trade like that. A few minutes on pound yen, you could be out on the same bar that you got in on. It's not impossible, and you could certainly be out in a few minutes, like we saw just a minute ago. This was like what was this, like about 25 minutes to get a 25 pip profit? Not bad. Okay, so that's pound yen. That's 1 for 3. Here is the cable major, pound USD. And again, coming into the new session, wasn't the stack phenomenon wasn't quite as crisp as the last example, but it was good enough. We had the 800 on bottom, positive slope, painting in green. We had the 400 above it, 200 above it, 100 above it. And this is an example where reading several similar crosses together could be actually advantageous, because I saw the setup on pound yen and it was really clear, and I saw the setup on pound Swissy at the same time, and it was also it was clearer than this. So these guys were all kind of pulling in the same direction, and that was just enough to tip me in favor of going for it. I did hesitate here just a little bit. I was looking at this price action and I thought, I'm not sure. But it was good enough because the two other pairs were strong, setting up strongly. The SMI reading was very clear. This was support on the quarter pivot. I don't know if you can see, but I've drawn in this gray horizontal line is the quarter pivot between the central pivot and M3. In my quarter pivot system that I use, I would refer to this as R25. That's 25% of the way between the central pivot and R1 or R100, R25, R50, R75, R100, so on and so forth. Doesn't matter, it's immaterial. The most important point is we've got support on the quarter pivot, bullish stack, parabolic is flipped green. Let's go for it. So I got in here and I got out here, and you can see this orange line actually is the R1 pivot painting in here. So my exit point was just a couple pips ahead of the pivot, which is actually not bad. The only reason I would choose to stay in longer is if I had some reason to believe this thing was going to continue going up, and it'll be interesting to me to see in the aftermath if it did. I wouldn't be surprised, but again, I just want 25 pips. Here we go. I got it. That's 2 for 3. And finally, the venerable pound Swissy, another great pair. I just love this pair. It's like pound yen. It just has incredible range and volatility. Tremendous to trade. Really good for this system. And the same story. This is almost the same chart. As you can see, we had the 800 on bottom, painting in green, positive slope, good angle and separation to the 400. And we had a pullback in the background here. Price had come up almost up to M3, just a little bit of a pullback, and then again, like on pound yen, found support on the 200 EMA. Just at that point, we had the good oversold crossover on SMI, and then parabolic flipped green, and I said get me in here. It was as soon as I saw this flip, I got in, and then you can see I got out, and this shows you in perspective. 25 pip limit on these pairs is pretty humble. It's a pretty humble objective to shoot for, because look at this, it's just a few candles, it's just on the chart, it's not a great big huge leap, is it? It's just a little distance. And then finally price went all the way. Now again, next week I'm going to show you a different variation of this where we're actually using the pivots to set our target. So what we might have done instead is just said, well, give me a one pivot target. So this pivot, R1, is 1831. I could have shaved 5 pips off there and set my limit up here. So you could see I would have gotten probably another 15 to 20 pips in addition, making this trade worth about probably in the range of about 40 to 45 pips total. But in here, out there, 25 pips in the bank. Thank you very much. So that's it for our examples. That's all I have to show you on these. These are very dead simple trades. Let's recap now what we've learned with this system. Okay, I'm just going to summarize what I believe to be sort of the pluses and minuses, pros and cons, advantages, disadvantages of this system. The things that I like about it, it's fun. It's just a fun way to trade. It's fun because what you see is a pattern of repetition. When you see these setups, and you see this happening over and over again, if you've experienced over quite a number of trades, it's almost like it's that issue of pattern recognition, and the market behaves in predictable ways when you look at it this way. It's fun. It's easy. It's dead simple. This is as simple a trade as I could possibly. I don't know how you could simplify anything further than this without making it dangerous somehow. So it's fun. It's easy. It's an easy 25 pips. It's mindless. You don't have to think. It's totally mechanical. Well, not totally mechanical. There are systems more mechanical than this, but the application of it is pretty straightforward. You just apply some simple math logic, and you're in and out. And it's usually a pretty high probability trade. The only time when you could get stuck is if you're at a market top or bottom, and of course the EMAs are not necessarily going to help you figure that out. Other than, I would say, just be careful if you're looking at a setup where price has gone way beyond the moving average, which can be read as an overbought or oversold condition, in which case you might want to just cool your jets a bit, because there's a pretty good chance you'll see a major pullback. And again, the 800, 400 EMAs on a 3-minute chart will not necessarily guide you through that. What's to like about this trade also is that this is nothing more nor less than the buy the dip, sell the rallies idea that Peter refers to time and again. It's probably the most trustworthy rule of trading there is, and this is built on that idea. It's fun to get in and out of the market with money. As we saw in this trade, if you're pulling down a 1-lot trade every time you do this, or 2 or 5, however many you can afford reasonably, paying attention to Chris Lorry's very important rule, which is never risk more than 1.5% of your account value on a single trade. So, you can do multiple lots as long as you can afford it. But you're in and out so fast that you're not stressing. If you're going to take a big swing trade, you place the trade and you go to bed and you're probably dreaming about that trade in your sleep, because it's going to probably take a couple days. You're wondering how it's doing. You don't have to think about your trades for too long with this system. If you time it right, you don't usually experience much of a drawdown. At least that's been my experience. Now, those are all the pluses. Now, you have to think carefully if you want to even try this system, and I'm just saying this in a spirit of honesty. Please do not rush out there and try this, especially in your real account. Not until you've gotten a lot of practice under your belt with this. It's a simple and easy system, but any system that's new, you really have to try it out with no real financial risk to make sure that you like it, it works for you, and so on and so forth. So why might you not want to try this system? Well, up until now, we've really been talking about the importance of shooting for high reward to risk performance in your trading system, and I've beat this drum to death talking about how it's always important to be shooting for 3 to 1, 4 to 1, 5 to 1, 6 to 1 kind of trades, because what that will allow you to do is make money even if your win ratio is 50% and sometimes maybe even less, which can be important when you're just starting out. But this system does not provide that. You could, the open positions window I just showed you a few moments ago, we were risking as much as we were shooting for. So we're talking 1-to-1 reward to risk. I'm typically risking 25 pips to make 25 pips. So from that perspective, this thing is lousy, to be honest, just looking at it narrowly from that perspective. But again, sometimes maybe you want to bend the rules or break the rules for yourself. The reason why it would work in this case is because, as I mentioned, a win ratio, a high win ratio of this trading system is quite possible and doable, 75 to 80%. Now, I can't, I'm forbidden by law to offer promises of trading performance here. It's up to you and how you use it. But I've been using this for a while now, and I don't get that many losing trades with it. It's just all there is to it. So poor reward to risk, but maybe the way to look at it is more than offset with a high win ratio. If you stick to a 25 pip generic limit, of course, you're going to suffer opportunity loss. And I saw that in some of the chart examples here tonight. Price went higher than the spot where I got out at. 25 pips is a good number to work with in this system, because in my experience, these oscillator dips and parabolic and so on and so forth, it's very rare that price does not move at least 25 pips on the cable crosses. But you'll see price go past your target to the next pivot, and then the next pivot beyond that, and before you know it, you see a 200 pip move on pound yen, and you only got 25 pips of it. You're going to have to determine for yourself whether you're going to be comfortable with that or not. That's all there is to it. This isn't a particularly impressive style of trading. You're not going to get written up in any book of trading greatness for trading this style. But then again, maybe it's not how you trade, but rather your consistency over time and small steps and building up incrementally. So it's a simple trade, but it's not one that you'd brag to your friends at a cocktail party about, that's for sure. And the most important point you want to think about, the way I've showed you these examples tonight, we didn't do much of a top-down analysis at all. And we said at the very beginning of this course in Module 1, one of the cardinal rules of trading is multiple time frames, top-down analysis. So this system breaks that rule. So you're going to want to really give some thought to that, because all of the professionals, regardless of their particular system, they all say the same thing: use multiple time frames, top-down analysis, so on and so forth. But the system seems to work well enough that I can use it to scalp that way, and it usually works for me. So sometimes maybe you can break the rules if it's for a good reason. So at the end of the day, please just take those issues into consideration. Please don't run off and go, oh look, I saw somebody show me 3 quick back-to-back winning trades, I'm going to do it too. It's not necessarily that simple. You'll want to take some time to practice this and look at different scenarios where the Four Sisters setup is clear or not clear and what that meant. But in all, it's kind of interesting. And if you don't like some of those caveats I've just mentioned, another way is just use it as an entry signal system within your top-down approach. There's nothing wrong with that at all. You don't have to just use it as a scalping system. You can just use it as an alternative to the map system to get you in on a trade where the setup is on a higher time frame. So that's all I had for you this week. I hope you found this kind of interesting, kind of exciting. I like this system. It's fun. It's just in and out, 25 pips. What the heck? Not giving up on Fibonacci's on the 4-hour chart and so forth, but it's just a nice little alternative way to trade if you're looking for a different system. So I hope that's fun, or at least entertaining, or at least informative, and we'll talk to you next week. Thanks. Bye for now.